It's common belief that if you weren't born into money, you will never become rich. However, today I will show you otherwise. Gary's Economics, a top content creator and ex-city trader with a specialism in social inequality, recently released a video on this topic. Let's watch some of it now.
It is almost impossible to get rich if your parents are not rich. The game is set up in a way that you are being robbed of your wealth, and there's very little you can do as an individual to stop that. All of the legitimate paths to getting rich are basically blocked, and it's almost impossible. So like the people who come from the same financial background as you, if you work harder than them and get a better job, you will be able to get slightly better off than them. But you will never be able to jump up to the level of somebody whose parents are richer. The only way to get rich nowadays is to inherit money from your parents.
Having grown up in ordinary and more elite environments, what he is saying does resonate with me. However, there are a few things that you can do to change the game. Being rich doesn't necessarily make you happy, especially if it comes as a trade-off against your more family life, having more free time, etc. But as the Wolf of Wall Street says,
there is no nobility in poverty. I have been a rich man and I have been a poor man, and I choose rich every fucking time.
The odds are stacked against us more than ever, especially with high inflation and rising unemployment. However, I've been able to do pretty well over the last 15 years by deploying these different tactics that I'll talk you through today. So number one, and arguably the most important, is to get the best paying job possible. Reason being, the more money that you have at the end of the month, the more money you can invest to build up your future wealth. You can obviously upskill yourself by doing online courses, qualifications, networking, reading articles and so forth. What I will say is try to future-proof what you do. So quite recently in the tech layoff, there's a lot of agile scrum masters that have recently been laid off, and I'm seeing on all of the forums it's taken them absolutely ages to get a new job. Whereas my friends working in jobs such as procurement or finance never struggle. Whatever you're doing, try to understand how that can be future-proof. Up next is to learn basic economic theory and good money habits. By understanding both of these things, first you can ensure that you're avoiding debt, you're investing in yourself, and you're actually building your future wealth. But secondly, with the economics theory, you know how the market's likely to react to things such as quantitative easing, interest rates going down and so forth. By understanding both of these things, you can put yourself on a path towards financial freedom. So good money habits include things such as paying yourself first, avoiding debt, minimizing any cost or interest you pay on loans, having an emergency fund, and also maximizing your pension contributions. Basic economics theory, on the other hand, talks about how things will react to certain catalysts. So things such as interest rates going down and the potential for them to increase asset prices. Likewise, quantitative easing, so when the governments and central banks print money, and the impact that will have on asset prices, as well as things such as wars and supply chain issues. Understanding these things can help you to actually position yourself when it comes to upcoming catalysts to maximize and make money from these. What I will say is always keep a breadth of the latest financial and economics news, and also understand how things are changing, because this is where you can really make some good money by understanding how the dynamics work and how to position yourself. To put this into perspective, you wouldn't go to gym once and then expect to win Mr. Olympia. You've got to learn the techniques and maintain it to become strong. This is like financial education. By understanding these things, and this is where I get really excited about economic theory, because once you understand these things, you apply it into an environment in where you're investing, you're trading, or you're taking out your mortgage, etc. You can actually see how you've made so much money as a result of that. To learn these things and stay abreast of the latest news, I personally follow things such as the Financial Times, which is a financial reporting newspaper in the UK, or read various articles online. Secondly, you have YouTube channels such as this one, in which I'll be doing reaction videos telling you what I think will happen to asset prices. So please like and subscribe if you want to follow up with that. And likewise, there's many online courses and so forth. So number 3 is to start investing in relatively safe assets as soon as possible. Once you've paid off all of your debt, start investing as much as you possibly can from your disposable income, because with the magic of compound interest, this is where you can really make yourself rich. To show you exactly what I mean, if you save £200 a month with a compound interest rate of 10.13%, which is essentially what the S&P 500 returns over the long term, you would have 41k with a net gain of 17k. If you were to do this for 40 years, you'd have 1.3 million with a net gain of 1.2. So that is a significant amount of gain as a result of that. And this is where compound interest comes into play. And really at the end of that term, so even 20 to 40 years is where your money really compounds and just goes crazy like a rocket. Personally, I really like low cost ETFs such as the S&P 500. Especially if you can minimize the fees associated with that. Personally, I buy through Trading 212, and Invest Engine, but there's many platforms out there. With these, you're able to get exposure to the top 500 companies in the US, so relatively low risk, because as the companies go up and down in the rankings, they drop out and a new one comes in. So you're always investing in the top 500 companies in the US by investing in the S&P 500. And over the long term, it's had a growth rate of 10.13%. So number 4 is to invest in a house as soon as you can possibly afford it. And this is where Gary's Economics talked about how if you're from an ordinary background, you won't have any inheritance from your parents, and therefore you're really going to struggle to get onto that property ladder. And property is where a lot of people make their net wealth. So if you can save your money by doing 1, 2, and 3, so maximizing your income, secondly, having good money habits, and third, investing in safe assets, when the time comes to it and you've got enough money for a deposit, buy a house. The reason I say this is because I was able to buy my first house for £6,500. After 2 years, I was able to sell that and made a net gain of £34,000. I then invested in another house, which a couple of years later, I made £45,000. And now my house I own with my partner is up about 160k. So I've been able to pay down a lot of capital in terms of paying a mortgage rather than rent, but equally had net gain from investing in the property. So this is one that can really differentiate yourself from ordinary people, as Gary's Economics says. So invest in a property when you can. You'll see a lot of millionaires, even from low income backgrounds, that have invested in property over the years and are now very rich as a result of this. Quite often they're landlords, and this is how they make money, by having rental income and also the capital gains associated with property prices increasing. Number 5, and this one does come with some risk, but potentially high reward. And this is to invest in riskier assets. So once you've got your property and once you've invested in some safe assets, you've got good money habits, etc., start to think about investing in riskier assets such as individual stocks and also cryptocurrency. With this, you need to really manage your risk, because personally, I was actually down £35,000 when I invested in AMC, because I thought, look, this company is going to go to the moon. Fell into the hype, and I know I've learned a lot from that, but actually it's coming back now. But if you invest in risky assets, you can potentially make millions, but likewise, you can lose a lot of money as well. Likewise with cryptocurrency, and we're currently going through a bit of a crypto resurgence, potentially a crypto bull run over the next few years. If you invest your money here, you can potentially make a lot of money as well. One of my good friends, Chica, the guy I made a podcast with the other week, has actually been able to make £300,000 off of a £10,000 investment over the last month, which is pretty insane. But you have to have good risk management and the liquidity there to support that, because he can afford to lose that £10,000. I couldn't, so I wouldn't be able to have that risk exposure. But if you built your foundation right and you have some spare money, please feel free to invest in those riskier assets, but do manage your risk. Good ways to manage the risk include things such as dollar cost averaging. So this is potentially buying a small amount of that asset every week or month and smoothing it out over the long term. By doing this, you smooth the ups and the downs, so you're not always buying at the top or the bottom. You're going on hopefully a trajectory upwards. Another good way to manage this as well, but you do often get stopped out, is to have a trading stop loss. Number 6 is to keep learning, keep pushing yourself, and potentially set up a business. As the saying goes, no one ever gets rich working for someone else. Although I technically disagree with that if you work in financial services or even consulting or even the tech industry. Most people don't get rich by working for someone else. So if you've got a good foundation, you've got a good monthly income from the other sources of income that you have, please feel free to set up a business. Reason being is that you can become your own boss and you can potentially make a lot of money on the upside. And also, by being a business owner, it's pretty tax efficient if you have a good accountant there as well. What I will say is it is risky, it is scary, and actually a lot of people I know have lost money by setting up businesses. But likewise, I know a few of my friends from my MBA that currently have £1 million valuations on their businesses, even though they're very early in their scale-up phase. You also need to think about how you're going to fund that business, because you can go down the VC and private equity route. However, quite quickly, you will lose control of your company's direction, because those firms are going to have their view and their say on what they want you to do. If you go down the other route and, for example, bootstrap, and i.e. do things as cheaply as possible, you may not lose any control of your business, but you're going to struggle to grow as fast. So there's always a trade-off between being cash rich and also being the king of your business. So think about that early on as well. And one thing I will say as well is cash flow is the biggest killer of companies. Companies don't go bust because their idea is crap. They go bust because their cash flow runs out. So always ensure that you're managing your expenses well, you've got a good runway with your cash, and that you're managing this so you don't go bust. And finally, number 7, to actually maximize your growth potential and your wealth, you need to pay taxes like the rich. And no, I'm not meaning that you do anything illegal here, no tax evasion. What I'm talking about is actually by being tax savvy and minimizing the tax you're paying. So if, for example, you're a high earner, you're on the £100,000 threshold, there's something called an effective tax rate of 60%, 62 including NI, between the 100 and the 120k. So actually, if you're in that level, it makes sense to pay any increment between that 100 and 120 into things such as a pension, because that's pre-tax and therefore lowers that tax rate that you're due to pay. Other things as well is you can potentially set yourself up as a limited company and pay yourself dividends instead of obviously pay as you earn and so forth. So I'm not a financial advisor, so I can't give you too much information on that, but there's lots of stuff online, and also potentially speak to an accountant, because this is where you can potentially save yourself a lot of money and invest in your future. So finally, the most important thing when it comes to becoming rich is to ensure that you have good money habits and don't make bad money mistakes. I recently made this video here talking about the money mistakes that I made as a 34-year-old working in the banking industry over my last 15 years or so you can learn from these and hopefully don't make the same mistakes. If you like this video, please like and subscribe, and I hope to see you back here soon. Bye-bye.